Hello everyone and welcome to John's January retirement account review. Sorry for the delayed video. My grandfather was in the hospital and ultimately passed away, so I wanted to spend as much time with him as I could before that happened. And then between that, family got COVID, lots of different things going on, but yeah, my goal is to get caught up, like you guys have heard me talk about before, when I've gotten behind. But anyway, let's jump into our numbers. There's a lot to go over in this one. I've added a couple things. And then also, just for future interest, I have been working with someone to try and, get some better images for like thumbnails and things like that. So just trying to do things that kind of make it a little bit nicer, more presentable. So I'm trying to expand my skill set there. So thanks everyone for your patience, and I know it's nothing high tech, nothing flashy, but hopefully you find the numbers compelling enough to make up for that. So I'm not a financial advisor, I don't claim to be one, and this video is made on my own and does not reflect the views or opinions of my employer. I do share a number of positions in common with John, and I have those listed on the screen. And then this is a real portfolio with actual shares being traded. It's not a practice portfolio, and that's why I include so many screenshots to try and demonstrate that these are actual trades being made, actual money that is being utilized. So I just want to make that 100% clear. With John and Jane, a while ago, they were taken advantage of, in my opinion, by their financial advisor, who switched to a different advisory firm and then got them to switch their mutual funds and charge them their load fees over again. And ultimately it cost them a lot of money, and it wasn't something that was disclosed. It was something we actually had to go back and look through statements to understand exactly what happened. But basically they got frustrated, and we've talked about managing things for years, and our relationship goes back more than a decade. But basically, in exchange for me doing this for them, I just asked that they let me write about them and make these videos, because I want to make sure that we have the ability to help as many other people as we can who maybe don't have someone that's got this level of interest in their lives, or at least someone that can point them in the right direction so they can see it's not as difficult as a lot of people might think it is to manage your own portfolio. So for their background, they're both retired, and they do collect Social Security. That is the only form of income they have other than what they have saved for their retirement. So in addition to that, they take $1,700 a month currently from the taxable portfolio. And then John increased his withdrawal from his traditional IRA to $1,106.17. And that was in order to meet his RMD for 2024. So they do have some other investments outside of what I help them with, and this consists primarily of low-risk bonds, certificates, things like that. And then John and Jane have no debt or monthly payments other than basic recurring bills such as water, power, property taxes, things like that. So for our headlines here, traditional IRA generated $1,202.24 of income in January 2024, and that is compared with $1,236.70 in January of 2023. The Roth IRA generated just under $1,130 of income in January of 2024, and that's compared with just under $950 of income in January of 2023. So pretty much flat for the traditional IRA, but a substantial increase in the Roth IRA. And then for the traditional IRA, the balance was just over $347,000 at the end of January of 2024, and that compares with $372,000 in January of 2023, and we'll look at that a little bit more later on. And then for the Roth IRA, balance of $216,000 in January of 2024, and that compares with just under $218,000 in January of 2023. So pretty good balance there with the Roth IRA, pretty much flat year over year. But with the traditional IRA, we do have to end up taking into account the withdrawals that are being made, but still down year over year. So 6 companies paid increase increased dividends or a special dividend during the month of January, and one company actually decreased their dividend payout. And you guys, if you've watched the other videos, you'll know that's WP Carey, because I've covered them in both of those videos, and I'll go into some detail with them here shortly. So with Apple Hospitality, they paid a special dividend, one-time special dividend of 5 cents a share in addition to their normal 8 cents a share per month. Brixmor was a 4.8% increase. Kite Realty was a 4.2% increase. Realty Income was its normal 0.2% increase. Bank OZK was its normal 1 cent per share per quarter increase. And then Toronto Dominion was a 6.3% increase. So with WPC, I'm not going to go into extensive detail because I've covered it in the previous videos, but I do believe that the company is in better shape than it was prior to the spinoff. And so the dividend reduction, a lot of people saw that as a major negative. I actually view the company with a better long-term outlook, even though, its share price is likely going to experience some pain, moving forward. But anyway, I still think that it's a potentially good entry point for those who are looking to add to it or establish a position. And I think that there's a lot of positives, even though it did experience a dividend increase of just under 20%. So for each of the companies that did raise or offered a special dividend, I want to go in and show you guys how much money has been collected from dividends from that stock, so that you can see kind of how things have changed over time, and then how much is going to be collected moving forward, assuming that it continues to pay the amount that is currently going out. So in total, John has collected $884 of dividends from Apple Hospitality since March of 2020. The current position is set to produce $480 of dividend income annually. One of the reasons for this is that from March of 2020 through the next year, Apple Hospitality did not actually pay a dividend at all during that part of COVID, and then when it came back, it started paying it quarterly instead of monthly, and then now it's finally starting to get back to pre-COVID levels. So that's one of the reasons why it looks like the portfolio is generating significantly more income now than what it did over the last 4 years. And then also I will mention that with Apple's position, we've improved the cost basis of it substantially. So you notice that every tranche of shares purchased is in the green, and that's been something that has been worked on for quite a while now in terms of buying low, selling high, and just kind of maximizing that benefit. So for Brixmor, in total, John's collected just under $1,300 of dividends since April of 2020. And then after the most recent dividend increase, it's set to produce just over $460 of dividend income annually. And you can see here that it's a similar situation where with Brixmor, it's most everything is very much in the green, with only the more recent purchase here, and not even really that recent, honestly, being in the red. It's something where I wouldn't plan on selling these 75 shares because my long-term outlook for Brixmor is positive. Maybe if the share price went up to $23.50, $24, somewhere in there, would we then be more interested in actually selling off these shares, because then that would be kind of the high end of what the stock's valuation would support at this point in time. So with Kite Realty, John has collected $804.80 since April of 2020. And then after the increase, the current position is set to produce $200 of dividend income annually. So one of the reasons here is that we've reduced the size of the position. We've also been working on getting the cost basis down on it, but also Kite Realty cut its dividend substantially and has since been increasing it by a pretty good pace. So my outlook for Kite Realty is definitely good in the long run. I think it was a strategic dividend cut when they did make it, and again, they've been increasing it substantially ever since then. So I think that they are definitely headed in the right direction. And then for realty income, interestingly enough, realty income in the taxable and in Jane's portfolio is actually sitting at a very strong cost basis. John's is a little bit of a scenario of, we bought a little bit too high here back in 2021. And so anyway, I think that there's some opportunity here for us to reduce the cost basis. We aren't necessarily looking to add to realty income anytime soon after their purchase of Spirit Realty. There's a lot of kind of what ifs I want to see more of before we start looking at adding here, and I think that's kind of one reason why the stock price is down as much as it is. So John's collected a substantial amount, $2,300 since March of 2020, and then after the increase, it produces just under $770 annually of dividend income. And then with OZK, John's collected $875 of income from them since April of 2020. And the current position is set to only generate $152 of dividend income annually. And the reason for that is that we cut the position down by nearly half. And that was partly due to the price of shares. This was, I believe it was around $47 or $48 a share that we did that at. And so really it just came down to the stock pushing the high end of its valuation. And that was the reason why we chose to trim it back. But that is one reason why the amount of dividend income produced right now isn't in alignment with how much has been produced over the last 4 years. And then for, lastly, for Toronto Dominion, John's collected just over $1,600 since April of 2020. This position now is set to generate just under $230 a share, or sorry, $230 for the position of income annually. And the big reason for that is that we also reduced the size of Toronto Dominion substantially. And also that's been another situation where we've been working on improving the cost basis of the shares. But also I have concerns about the Canadian banking system. There's just a lot of things going on that I have concerns about with them, especially in terms of the overvaluation of the real estate. I think it even makes America's current real estate situation look reasonable by comparison. So anyway, I just think there's a lot of concerns about affordability and things like that, and that those might be some things that start pressing on the stock price moving forward. And then for, and this one's lastly, WP Carey. So just under $3,200 of income since April of 2020. And then after the dividend decrease, current position is set to generate $722 of income moving forward. So as you can see here, that would work out over a 4-year period, which is about what this is here, would be about $2,900. So it's not, I wouldn't call it a substantial decrease to the position, but also some of that is being made up for with some of the recent purchases that you see here, because otherwise a good chunk of this position, 75% of it is, has been established a very long time ago. So for our trades, purchase-wise, we did purchase shares of Black Hills Corporation, so the utility company. I did write an article on Seeking Alpha about utilities and my top 4 utilities that were on my watch list, and Black Hills was actually the one that I had said was actually at the point where we would look at buying shares. and so it was a good time to buy. We've since added some more shares when it dropped under $50 a share. Yeah, Black Hills is, as far as I'm concerned, it's a solid utility pick, especially for a retiree to have. And then for Kinder Morgan here, we've been looking to cut back and eliminate the Kinder Morgan position altogether. And so it's been a matter of the share price just not having hit a high enough point. So we set the limit trade and set to eliminate it. Kinder Morgan is just not, I think there's just better options that are out there right now in terms of quality of company. So that's going to be something that we just decided that it was a good time to get rid of it. That way we don't have to do coverage on it anymore. Tightening up the portfolio a little bit. So for the Roth IRA, 2 CDs, money was invested into these, and then the Sun Communities REIT, we did add 10 shares here, so we continue to just kind of add to that position. We do have a high cost basis part of that position in terms of the cost of the shares that's on the much higher side. So we've been slowly building up the lower cost shares so that as that stock price recovers, we can sell off those high cost shares. So for the realized gains with having sold Kinder Morgan here, you can see that we John Jane took just under $190 loss on it. So it wasn't even, the price we sold at wasn't even the amount needed to be able to break even, but it was close enough in our book. And then for the Roth IRA, no sales were made in January of 2024, so there's no realized gains to report. Now for the year-to-date number here, you'll notice that these are good through February of 2029, and so you'll notice that there's been a small gain in the Roth IRA, and that's a trade that took place in the month of February, and that'll be covered in the February video when I make that here shortly. So for the January comparison, portfolio positions, since we're restarting at the beginning of the year, they're identical, and so it's kind of nice to start where these are now matching exactly. Quite a bit of income in 2023 came from positions that were eliminated. That was a total of $142.19 that you can see under this shares no longer held. And then also Bank of California acquires PacWest Bank Corp. So PacWest, PACW, now reports under BANC. And then for Charles Schwab Money Market, excuse me, and CD income represents a modest shift in where the income is being generated from, and that's going to be reflected right here. So for the Roth IRA comparison, again, same thing where we're starting with the same set of positions. Income is about $175 more for the month of January, and there's a clear shift that a lot of that is coming from the CD income that you see right here. And that CD income is likely going to be a consistent source of income moving forward, especially if we continue shifting away from equities into CDs and money market. So the year-over-year full comparison, we are starting the year with a estimated income deficit of negative 6.6% the traditional IRA and negative 7% in the Roth IRA. Now, I want to make it very clear that on these percentages here, this is us being extremely conservative, trying to look at kind of like the worst case scenario of, just no dividend increases. We don't earn any money off of certificates of deposit, or certificate of deposit rates collapse and are, paying a fraction of what they currently are. Again, these are very negative scenarios here that I do not actually believe will happen. It's just that on the screen I like to make sure that these numbers never reflect so positively that it makes those of you watching think that things are going to outperform. I'd rather have it pleasantly surprise everyone than have everyone look at it and say, well, he was a little bit too charitable about what was going to happen. So in this case, if say these numbers do come to fruition, with the traditional and the Roth, the portfolio income in 2023 was just under $2,260. And that compares with an estimated just over $2,100 in 2024 if these scenarios come to fruition. Now for the account balance, for the traditional IRA, it's down considerably year over year. Roth IRA, it's basically flat year over year. Even with those lower starting balances, if you look over here on the average balance, it's higher than what it was in 2024 than what it was in 2023. So I really like seeing this because this 372,000 is a clear outlier when you take into consideration what it was the rest of the year. And then for the traditional IRA, it does not factor in the $1,200 of withdrawals that were taken in 2023. So that's going to be something that, and I forgot to update this number here, but basically if we added in the $12,000 back, it would end up being, about a $12,500 deficit in terms of the balance in 2024 as compared to 2023 if we took no cash withdrawals. For the 6-year comparison, this is another one I forgot to update. This should say 7 years since now we're on 2024. And then the income reduction, again, take it with a grain of salt. And also it's not factoring in the money markets and CDs. But you can see here that, what things look like over the years. And then the Roth IRA is a little bit more interesting. Again, this should say 7-year. But 2020 and 2021 were setback years due to COVID. There was a lot of dividend cuts or eliminations in the Roth IRA, and so that's one reason why it was heavily impacted. And then now every company in the portfolio has reinstated some form of dividend payment. So that's one reason why you can see that it's trended back up here recently, is that we definitely have had some companies reinstate their dividends, and it's added a substantial amount of income. And then it is possible that we will see the income, nearly double what was produced in 2018. But if we use the 7% here, it's saying that it would be a long shot. But I think that this number is going to be quite a bit higher, and I'll show you guys on another slide here kind of the direction that I think that it's actually going. But even if we remove 2024 here, cost of average goods return in terms of dividend growth works out to be about 13% a year. So even with the setback of 2020 and 2021, that is substantial. And any income investor would be pretty stoked to have a 13% increase in their income year over year. So for the cash balances, just want to make it clear, it does not reflect any investments in CDs and money market. This is only referring to liquid cash. John currently has $15,000 in Charles Schwab money market and $26,600 of cash on the sidelines in the traditional IRA, and that was as of March 3rd, 2024. And the goal with the cash on hand, make sure you have enough to be able to take advantage of buying opportunities, but at the same time, not so much that we're sacrificing additional yield that could have improved John's income. And then the cash balances for the Roth IRA, John has $20,000 currently in the CDs and just over $30,000 in actual liquid cash in that portfolio. So you can see that that number is substantially higher because of some sales that have been made, you know, some CDs that have expired, things like that. And that's one reason why I like to show cash, is just to see how that fluctuates. And then for the unrealized gain loss, so traditional IRA gain loss has bounced back and forth between gains and losses for the last several months. So 5 out of 12 months in 2023 were in the red, and then the other 7 obviously were in the black. And so one thing that the unrealized gains doesn't reflect is the impact that could have happened or would have happened had we not realized some of the gains or realized some of the losses. So for example, in 2023, there was $7,200 in realized gains. Those $7,200 are taken away from the unrealized gains. And so if you actually factor it in on some of these, you know, lower negative ones here, we would have actually been in the positive for an additional 2 months, and then been very close with some of these other ones here. So the thing is that it's really easy for someone to be able to say, look how great my portfolio is doing. I'm sitting on all these gains, while at the same time maybe they recently sold all of their losers in order to make it look like they only have a portfolio that's performing extremely well, even though they've taken thousands of dollars in losses. So the reason why I wanted to show this is because if the $7,200 was realized losses, then these numbers, it would be the opposite, where like this would have been a negative in the month of June of 2023. This would have been a negative in the month of December of 2023, right? So, you know, it's, again, someone can manipulate this really easily by basically selling off, you know, their major losers. But also, in our circumstance, things are looking not as good as they could have been looking potentially, because we sold off the ones that were performing well, but we sold them off because we thought it was the right thing to do rather than trying to make the results look better. Now with the Roth IRA, same thing here, except for last year it was 10 out of the 12 months it was in the red, and it's still currently in the red, and even as of February it's slightly in the red. And then there's no withdrawals taken from the Roth IRA. However, a similar situation here where it was just over $4,000 in realized gains, meaning that it would have been positive on several of these months that you see, or at least very close, had those realized gains not been recognized. So again, it's just the narrative, or at least the story that can be told if someone doesn't want to disclose unrealized and realized. It could be easy to make it seem like someone's portfolio is performing better or worse, even when the opposite is actually true. So for the traditional IRA withdrawals, I mentioned that the withdrawals were increased to $1,106.17 a month. And even at the worst case scenario for the traditional IRA, we're estimating the $1,326.02 a month of income. So my goal here is to make sure that the amount of income being generated is greater than the amount that's being withdrawn, because then that tells us that we have a sustainable RMD and a sustainable income for John to live off of. If this number was lower, which it's possible that that will happen, and in fact, almost certainly likely to happen, is that it would then require potentially the sale of certain shares in order to come up with that. So that also goes back to cash on hand and why it's important to have a certain amount of cash on hand. So On the traditional IRA, on the gain loss here, I did go back and update this because the yields were off for some reason. But also on the percentage of income, I added this column so that now not only can you see what percent of the account it makes up. So like for example with Chevron here, 6.61% of all invested dollars is in Chevron for the traditional IRA, but it also now tells us that based on the dividend that it is responsible for just over 5% of all of the income that this portfolio produces. So this is kind of helpful so that you can see, okay, there might be a position that's a smaller amount but generates a large amount of income. For example, AFCG here has an extremely high dividend yield, and that's the reason why you see it being a small amount of the account, because we want to reduce the risk, but also it still generates a substantial amount of income. But then the opposite is also true, where we have a entity like Bank of California here, where it makes up 0.6%, but it only generates 0.33% of the income, and that's because in part that the yield is very low by comparison. For the Roth IRA here, same exact thing. I updated these yields with these color codings too. I'll just mention that when it's something that's in the red, it's just more there to alert me so that it's like, okay, should I really be having that much exposure to that position, and should I have that much income exposure to it? And in this case, since it's UTF, a diversified closed-ended utility fund, this is reasonable to me that these numbers are this high. But if, say for instance, it was a single company that had that level of responsibility for income, it would be something that I would definitely want to check in on more, and just make sure that it's, our investment is reasonable. So for the traditional IRA, this is the one that new table I think will really help out, and this has the more realistic expectations and will kind of show how over time how the increases actually come into play, whether it was an increase for that quarter, decrease for that quarter, so that way you can go back and see kind of how those results month to month bounce around. But based on the numbers here, and I'll cover the traditional IRA and then I'll show you the Roth IRA one, and it's because it's set up the same exact way. But 2024 excluding CDs, so this is all income coming in that's actually subject to potential dividend increases, and we're excluding the CDs since CDs are not subject to potential dividend increases. Then we added this column, which is the estimated amount of income from money market and certificates. And again, this is not, these numbers here are not subject to increases. So that's part of the reason why we have them separate, is because we don't want to say that, a 7% increase on our CD income is something that's even possible to happen. And so you can see here that the total income for 2024 is in this column here, and that compares with the total income in 2023 in this column here. And then over here, the 3%, 5%, and 7% increase, these are really here kind of as place markers, really just saying, okay, what if we did a 3% increase over 2023, or a 5% increase over 2023, 7% increase over 2023. And then the last column here, where you see the actual increase, is negative 1.99%. So in this case, because this amount was lower than this here, that is what tells you that it did not meet that 3% increase threshold, and in this case it was actually negative. Now when you go down to the bottom here, you can see total amount generated in 2023, total amount estimated in 2024 when we exclude certificates and money markets, certificates and money markets, and where we expect the number to be in 2024, and that works out to be about a 7.8%. So the good news is that as time goes on, this number is going to continue to get more dialed in, but also you'll be able to see whether or not, whether or not here, like in February, was it an increase, was it a decrease? I've never given the visibility before so that people can kind of look and see what's happened in the prior months. But in this case, we do estimate that on the traditional IRA, that it is up for a potential just under 8% year-over-year increase in income. And then for the Roth IRA, same exact thing. In this case, for January, it was a whopping almost 19% increase in income year over year. And you can see how we have it broken down up here. But also you can see down here that we're saying that it's on track for generating a 17% increase in income year over year based on the current numbers that we have. And again, that will continue to get more accurate as time goes on. So for conclusion, I just want to point out, I've been talking for a while about how higher for longer when it comes to interest rates is how I expect things to be working, and I think that this unrealistic optimism for the market and that the Fed's just going to start slashing rates, I think is finally starting to dissipate. I'm seeing a lot more headlines, things like that, and so good news is that from a investor's perspective, it gives more opportunity for us to transition from volatile equities to stable and compelling yield fixed rate investments. We've relied for years on the equities and in order to generate the return that was needed, and so now we actually have the other tools like certificates, bonds, money markets, and things like that to create more stability and balance from a retiree's perspective. And then with the market continuing to push higher, it makes sense that we would reduce the risk in the portfolio because the potential for upside is getting more limited, as the market continues to move higher. There comes a point where it has to come back down. So in this case, yes, are we capping ourselves on the potential upside? Yes. But we're also capping the potential risk on the downside. So, and just remember, as always, a successful portfolio here is going to be focused on generating income and that making that income sustainable over time. And so, it takes away the concern about a volatile market, as you can see when it came to the balances in the portfolio shifting up and down. It is basically the least of my concern. My concern has more to do with the income that's being generated and the sustainability of that income. So it's more about the quality of the company rather than what the stock price is at a certain date or time. Alright everyone, thanks for watching the video. Let me know if there's anything I can do better. I apologize that this video was so long. I'm trying to do my best to get caught up here with the other things. I'll be getting the other February videos out. Hopefully I'll have my new thumbnails here shortly, and I'll still keep posting articles to Seeking Alpha. But yeah, if you guys could give me likes and comments and different things like that to help out with YouTube, I would greatly appreciate it because that algorithm is quite difficult to work with. So anyway, thanks everyone. Appreciate your time. Have a great day.